Finish your drink. Drain the glass. It's time to bury the body. We have arrived at the final stage of the asset life cycle, derecognition. In plain English, disposal. We bought it, we capitalized it, we depreciated it, we componentized it, and we impaired it. Now it's time to say goodbye. This is where we kick the asset off the balance sheet and see if we made any money on the way out. You would think selling something is a happy occasion. You get cash. Cash is king. But in accounting, getting cash is not enough. We have to ruin the moment by calculating a gain or loss on disposal. This is the part that confuses every CEO. We sold the truck for $10,000. Great profit. But wait, the truck was on our books for $15,000. So we just lost $5,000. We have $10,000 in the bank, but we are spiritually poorer. It is the final insult. Even when you get paid, the accountants might tell you that you actually lost money because your depreciation schedule was too optimistic. Think of derecognition like finally breaking up with a toxic partner. The disposal date, the day they finally move out of your apartment. The proceeds, they leave behind the nice espresso machine, value $500. The carrying amount. They also leave behind a massive emotional void, 3 unpaid utility bills, and a cat you hate. You are stuck with the emotional damage and the cat, value minus $2,000. Net result, you are in a loss position of minus $1,500. You cannot go to the bar and tell your friends, I won the breakup because I got the coffee maker. They will look at you holding the cat and know the truth. You are in the red. Under IAS 16, you must derecognize an asset when you dispose of it, or no future economic benefits are expected from its use or disposal. Net disposal proceeds, the cash you got minus any transaction costs. Carrying amount, the cost minus accumulated depreciation minus impairment. Gain or loss, net disposal proceeds minus carrying amount. You cannot call the proceeds revenue. If you sell shoes, selling a shoe is revenue. If you sell the factory that makes the shoes, that is not revenue. Why? Because if you record it as revenue, you mess up your gross margin and trick investors into thinking your sales are booming. Where does it go? It goes to the P&L as other income if a gain, or other expenses if a loss. It sits below the operating profit line, away from the core business numbers. Here is your final strategic duty. Audit your fixed asset register. I once consulted for a company that was still depreciating a fleet of cars they had sold 3 years prior. They were paying insurance and taxes on ghost assets. If your balance sheet is full of assets that don't exist, you are inflating your equity. When the auditors find out, and they will, you will have to write them all off at once. That creates a massive loss on disposal that can wipe out your annual bonus. When the asset leaves the building, kill it in the ledger immediately. If you sold it for more than book value, great, you depreciated it too fast. If you sold it for less than book value, oops, you depreciated it too slow. And with that, the machine is gone. The ledger is clean. The drink is finished.